Discounted cash flow, DCF, is a financial valuation method used to estimate the value of an investment based on its expected future cash flows. The valuation process involves forecasting the future cash flows that the investment is expected to generate and then discounting those cash flows to determine their present value. The primary principle behind DCF is the time value of money, which posits that a dollar today is worth more than a dollar in the future due to its potential earning capacity. This method is widely used in industries such as finance, real estate, and business valuation. The key components of DCF include forecasted cash flows, discount rate, and terminal value. Forecasted cash flows represent the estimated amounts of money that will be received from the investment in the future. These can be regular income streams or a lump sum amount, depending on the nature of the asset. The discount rate is a crucial element in DCF, serving as the rate of return required to account for the time value of money. It often represents the cost of capital or the expected rate of return from an alternative investment with similar risk characteristics. The terminal value accounts for the value of the investment at the end of the forecast period, capturing the ongoing value beyond the explicit projection. Calculating DCF begins with estimating the future cash flows over a projection period. These cash flows are then discounted back to their present value using the chosen discount rate. The sum of the present values of the individual cash flows, including the terminal value, represents the total value of the investment. The DCF method can provide a more accurate reflection of an investment's value compared to simpler techniques, as it incorporates various factors such as risk and the time value of money. However, it is not without limitations. The DCF model requires accurate forecasting, which can be challenging due to market volatility and changing economic conditions. To perform a DCF analysis effectively, follow the steps outlined below. First, forecast the expected cash flows. Start by projecting the future cash flows that the investment or asset is expected to generate. This forecast typically spans over a specific period, such as 5 to 10 years, and includes revenues, operating expenses, taxes, changes in working capital, and capital expenditures. Second, determine the discount rate. The discount rate represents the required rate of return on the investment. It is often derived from the company's weighted average cost of capital, WACC, which accounts for the cost of equity and the cost of debt. The discount rate should reflect the risk profile of the investment. Third, calculate the present value of projected cash flows. Apply the chosen discount rate to each forecasted cash flow to derive its present value. This step involves using the formula PV equals CF slash open parenthesis 1 plus r close parenthesis to the power of n, where PV is the present value, CF is the cash flow for a specific period, r is the discount rate, and n is the period number. Fourth, sum the present values. Once the present values of all forecasted cash flows are computed, aggregate them to obtain the overall present value of the cash flows for the specified period. This sum represents the present value of the investment's cash flow over the forecast period. Fifth, estimate the terminal value. Since businesses are assumed to continue operating beyond the forecast period, estimating a terminal value is essential. Two common methods for calculating terminal value are the perpetuity growth model, where the final year's cash flow is assumed to grow at a constant rate indefinitely, and the exit multiple method, which involves applying a market valuation multiple to the final year's forecasted cash flow. Sixth, discount the terminal value. Just as with individual cash flows, the terminal value must be discounted back to its present value using the same discount rate. If the perpetuity growth model is used, the formula is TV equals CF asterisk 1 plus G forward slash RG, where TV is the terminal value, CF is the final year's cash flow, G is the perpetuity growth rate, and R is the discount rate.